Hi, and welcome to InvestEngine's education series, a space for both beginners and expert investors where we'll explore the principles of investing and also share insights on it. I'm Ramin Nakisa, an investment coach and founder of the PensionCraft YouTube channel, and today we'll be discussing self-invested personal pensions, or SIPPs, why they exist and how they can help you plan for your retirement. Let's begin with the definition of a SIPP. As its name suggests, this is a pension plan that allows you to build up a pot of money for when you retire. As it's self-invested, it allows you complete control over the investments you choose for your retirement. And it offers you a huge choice over the types of investments that you can buy. Furthermore, you can make changes to your SIPP investments whenever you want. You also control how often you save and how much you save, subject to some limits. One of the benefits of a SIPP is that your investments can grow within the SIPP free of capital gains and income tax. Over many years, this tax efficiency can boost the return on your SIPP investments. Another benefit is that any contributions of new money you make into the SIPP get basic rate income tax relief at source. That's just a fancy way of saying that the government tops up your contributions. For every £800 that you contribute, this is topped up to £1,000 thanks to a £200 contribution from the government. The higher the tax you pay, the more the tax relief you get. If you're a higher rate taxpayer, for example, you can claim back an additional £200 in your self-assessment tax return for every £600 that you contribute. And if you're an additional rate taxpayer, you can claim back up to £250 in your self-assessment tax return. The tax relief may change in future if the tax rules are changed, but you can see that it can positively impact your contributions. If we see that graphically, it becomes clear how tax efficient a SIPP can be if you're paying higher rates of income tax. For high earners with a salary of over £100,000, they'll lose their personal allowance. But by making contributions to their SIPP, high earners can effectively reduce their adjusted net income. This is because pension contributions are deducted from your income before your tax liability is calculated. There are limits to how much you can put into a SIPP each year. Each year you can put in up to 100% of your earnings, but that's also capped at £60,000 per year. If you've used up this year's allowance, you can carry forward pension allowances from the previous 3 years. But you need to have been an active member of a relevant pension scheme, such as a SIPP, during that period. You also need to have earned at least what you want to contribute in total. You have a wide variety of investment choices within your SIPP wrapper. These include exchange-traded funds, and InvestEngine has several hundred of these which are eligible for your SIPP. These give you the ability to buy a wide range of asset types, such as stocks, bonds, commodities, or funds that invest around some investment theme, like artificial intelligence. These are called thematic funds. All of these types of ETF are available on InvestEngine and can be held inside its SIPP account. Once we've set up a SIPP and funded it, we need to select investments. Exchange-traded funds, or ETFs, are a great way to invest. Exchange-traded funds offer a simple and direct way to invest. If we compare investing in ETFs within an InvestEngine SIPP wrapper with, say, a company pension scheme, the ETF approach is much more under your control. Firstly, company pensions tend to offer a restricted choice of funds, whereas a SIPP on InvestEngine offers you hundreds of ETFs to choose from, and you can change your allocation whenever you like. Secondly, the company pension scheme will invest as you earn, whereas with the InvestEngine SIPP, you choose when to make contributions. And finally, the fees that you pay on a platform like InvestEngine will likely be much lower and more transparent than those you pay on your company's pension scheme. Your InvestEngine SIPP gives you complete control about which ETFs to buy, but that begs the question of how to choose the best ETFs. Although stocks are notorious for crashing, a fact that's often forgotten is that over the long term, they've rewarded patient investors with high returns. Of course, future returns may be different, but over the last 120 years, US stocks have beaten inflation by an average of well over 6%. That's much better than bonds or short-term bonds, which are also called T-bills. Furthermore, by buying an ETF which contains hundreds or even thousands of stocks, you're not exposed to the risk of a single stock crashing. Given the high average return and inflation-beating abilities of stocks, they form the backbone of any long-term investment strategy. And as SIPPs are usually long-term investments, they're naturally suited to stock investments. InvestEngine offers many choices of global stock funds that are diversified across stock markets of multiple countries, and which also offer very low fees. So here we are on the InvestEngine platform, and if I search for the word world and look for equity funds, here's a low fee one from Invesco, and we'll add that to our portfolio. If you do want to invest for shorter periods of time, or you're not comfortable with the volatile nature of stocks, then combining stocks with less volatile funds, such as bond funds or money market funds, will usually reduce the paper losses in your portfolio when stocks fall. In return, you'll sacrifice some of your long-term return. For example, if we search for money market fund on InvestEngine, this one with ticker XSTR is an example of a lower risk fund, but you'll sacrifice some long-term return for this safety. We then set our weights, which is how much of each investment goes into our portfolio. The weights have to add up to 100%. InvestEngine allows us to see what's within our portfolio, and we can either break it down by the regional level, the amount of each sector, or individual stock holdings. InvestEngine has a wide range of exchange-traded funds that allow you to get exposure to a wide range of asset classes. That includes shares, bonds, and investment themes. These are funds that have a particular style of investing, such as income or growth, or even individual sectors. For example, you might want to buy exposure to the stocks of a single country, like the United States, such as the Xtracker's S&P 500 fund that tracks the well-known S&P 500 index of the 500 largest stocks that trade in the US. Or perhaps you want to buy UK mid-cap stocks, in which case you'd consider funds like the Vanguard FTSE 250 ETF with ticker VMIG. Or perhaps you want to get exposure to gold to hedge your exposure to stocks, in which case you might go for funds like GLDW, the Wisdom Tree Core Physical Gold Fund. Alternatively, you may want to increase your exposure to regions like Europe, Japan, or emerging markets because you'll think they'll outperform. This is easily achieved by holding these alongside your global equity fund. Just remember that your view about which region will outperform may be wrong, in which case it's good to limit the size of your exposure relative to your global equity exposure. InvestEngine offers a compelling choice for your SIPP. Let's see why. Firstly, InvestEngine is very competitive when it comes to cost. If we assume that we hold a SIPP starting with £80,000 and invest for 2 decades, adding £10,000 per year with 12 ETF trades per year and with 5% investment growth, notice how InvestEngine's cost is the lowest. Put simply, with InvestEngine, you get to keep more of your investment returns. As well as being affordable, InvestEngine makes saving for your retirement incredibly easy, and this is for investors of all levels. You can build your own portfolio from InvestEngine's selection of hundreds of exchange-traded funds, or you could leave it up to InvestEngine's experts to manage your portfolio for an additional fee of just 0.25% per year. Or you can do a mix of both. InvestEngine's automated savings features are perfect for helping you stick to your investment plan. You can top up as little as £10, and that's weekly, fortnightly or monthly with savings plans, and put that money to work with Auto Invest. One-click rebalancing and smart top-ups help you stick to your plan from the app or the web portal. SIPPs are ideal for transferring and consolidating your existing older workplace pensions. There are a number of benefits of consolidating your existing pensions onto one platform. The first one is simplicity. If more of your pensions are in one place, it's easier to keep track of your investments. The second consideration is cost. Because InvestEngine has such competitive fees, it's likely that the overall fees that you pay for your InvestEngine SIPP will be lower than your legacy funds and platforms. Another consideration is that the InvestEngine interface via the website and the app makes it very easy to track and modify your investments. This puts you back in control of your pension. There are some caveats. For example, your existing pension provider may charge an exit fee. Transferring defined benefit pension funds is a much more complicated process and will require financial advice. I hope this has helped you understand how SIPPs can help you save for retirement in a tax-efficient way, and how InvestEngine SIPP is particularly well suited to maximizing your SIPP investment returns by keeping fees as low as possible. If you have found it helpful, don't forget to like, subscribe, and come back for more educational content, and check out investengine.com.